Welcome back to the deep dive. Today, our mission is, well, it's a deep exploration of a company that really sits at a crossroads.
Yeah, it's either a sleeping giant, trading way below what it should be, or maybe it's an essential service that's just caught in a nasty cyclical downturn.
We are plunging deep into Gartner Inc., ticker IT. They're the huge force in IT research and advisory, often called the Gartner gorilla.
And our analysis today is anchored to October 5th, 2025. The baseline share price we're looking at is $257.20.
Right. And here's the core conflict, the thing you really need to grapple with as you listen.
Gartner's competitive position, its moat, it seems almost indispensable. They sell essential knowledge, right?
Yeah, absolutely essential for many big companies.
But its market cap has just collapsed, fallen by a staggering 49% in 2025 alone.
Wow.
That's a drop from over $37 billion down to around $19.5 billion.
A nearly 50% haircut on a company with a business model that on the surface looks unbreakable, that demands a closer look.
Definitely. So our goal here is to figure out if the market's deep pessimism is, justified. Is the gorilla actually wounded?
Or is this just a massive overreaction, a radical price drop creating a potential value opportunity?
Exactly. We need to systematically unpack the business quality, the management decisions, the financials, the market risks.
To understand why the stock has just decoupled so dramatically from what seems like its fundamental reality.
Okay, so let's start at the beginning. The foundation. What exactly is Gartner selling and how do they make their money?
Right. Chapter 1. Business analysis. And the strength here, it's really built on this diversified, kind of self-reinforcing flywheel model, 3 key segments.
And these figures are based on 2024 results, which are pretty remarkable.
The absolute core, almost 88% of their revenue comes from research.
And this research segment, this is the bedrock of their power. It's subscription-based, highly recurring.
Sticky revenue.
Very sticky, typically 12-month minimum contracts, often multi-year deals. But the most critical economic piece here, it relates to cash flow. The contracts are non-cancelable.
Yeah.
And crucially, they are invoiced upfront.
Wait, hang on. Invoice up front. So they get paid today for a whole year of service, but the revenue gets recognized slowly over the next 12 months.
That's exactly it. Think of it like a magazine subscription or maybe a software as a service deal. They get the cash immediately.
Which must make the revenue feel incredibly predictable, almost like a utility.
Precisely. Utility-like predictability, plus it gives them this significant cash flow to work with. It's a cash conversion advantage most businesses would kill for.
Okay, so beyond research.
They held 51 in-person conferences back in 2024. That brought in about 7 to 9% of revenue.
And that's not just a side hustle, right? It sounds like it feeds back into the main business.
Totally. It's a high-touch platform. It lets clients network, interact directly with analysts. It provides this critical feedback loop that actually makes the core research better, richer.
Got it. And the last piece.
Consulting. That's about 5% of revenue. This part leverages all that deep research for bespoke, high-stakes strategic projects for clients.
So it deepens the relationship, makes them even more embedded.
Exactly. Ensures they remain part of the core enterprise decision-making process.
Okay, now here's where I think it gets really interesting for you listening. The competitive mode. It's built on these unique, proprietary analytical frameworks that have basically become industry shorthand.
Yeah, everyone in IT knows them. We're talking about the Magic Quadrant, evaluating vendors into leaders, challengers, visionaries, niche players.
And the hype cycle, which plots technology maturity and adoption.
And these frameworks, they're more than just reports. They're like institutionalized decision support systems.
So the value proposition boils down to what?
Well, on one level, they sell actionable, objective insight, saving clients time, saving them money, helping manage risk in a complex tech world.
But there's something else too, right?
Yes. Maybe more importantly, they sell a form of career insurance, especially for CIOs. Think about it. If you're about to sign off on a massive, maybe billion-dollar IT contract, aligning your decision with what the Gartner gorilla says, well, it de-risks that choice for you personally as the executive making the call.
So it's a psychological moat as much as an informational one.
Absolutely. And the scale backs this up. Gartner serves nearly 14,000 enterprises across 90 countries.
That kind of scale must create huge barriers to entry.
Massive economies of scale, definitely, and really high switching costs for clients. There are procedural costs, relational costs, even learning costs involved in changing providers. It locks clients in.
Plus, they're riding these big, durable secular trends, aren't they?
For sure. Digital transformation, cloud adoption, cybersecurity, And now the sheer complexity being added by AI and automation, all this drives demand.
So the industry itself is expected to grow, what, 5.3% to 9.4% CAGR? Pretty healthy.
Very healthy underlying market growth. Okay, so the business model sounds really strong, almost fortress-like, but execution depends on leadership. How has management actually been deploying all that cash the business throws off?
Good question. Let's move to Chapter 2, Management Evaluation.
Okay.
So management's long-term strategy seems pretty consistent. They want to increase penetration within their existing valuable clients.
Get deeper into the ones they already have.
Right. And also expand the Gartner brand beyond just IT into other enterprise functions, HR, finance, legal. That was the big driver behind acquiring CEB back in 2017.
And to their credit, they seem grounded in reality. They've been open, quite candid actually, about the headwinds they faced in Q2 2025.
Yeah, they talked about declining CEO confidence, tariffs impacting decisions, corporate cost cutting.
That kind of candor is generally good, but their capital allocation choices really need a hard look.
Okay, so where are they putting the money? Their top investment priority is expanding the sales force. They talk about this vast, under-penetrated, addressable market.
Standard growth playbook. What about M&A?
They say it's disciplined, focused on smaller, strategic tuck-in acquisitions. Like CE was a big one, but mostly smaller deals to add capabilities incrementally.
Right. But the real story, or maybe the real controversy, is shareholder returns. They don't pay a dividend. It's all about share repurchases. Aggressive ones.
How aggressive?
Well, they bought back $274 million worth of shares just in Q2 2025.
Okay.
And then in July 2025, they authorized another $700 million for buybacks.
That's a lot of cash going back into the stock. What's the issue?
The issue is the price they paid, those Q2 repurchases. They were done at an average price of $446.06 per share.
Whoa, wait. $446? Let me just repeat that because, as you said, the price we're looking at today is $257.20.
Exactly. Buying back stock hand over fist at $446 when the price then collapses to $257 just months later. I mean, that looks like a colossal misallocation of capital.
Yeah, that's hard to defend. It raises serious questions about management's timing, their price discipline.
It absolutely throws up a massive red flag,
Yeah.
especially during a period of clear market stress and volatility. I mean, buybacks can signal confidence, sure.
But not at any price.
Not at that price. Executing them at such an elevated level, so far above where the stock quickly ended up, suggests a concerning, let's say, lack of strategic financial timing. You really have to ask, how aligned is this management team with long-term shareholders who actually depend on value accumulation over time?
That's a really sharp point of conflict, isn't it? It runs completely counter to the perceived quality of the underlying business itself, which maybe leads us perfectly into Chapter 3. Financial analysis. Can the numbers outweigh that management fumble?
Well, the quality of the actual business operations, it absolutely shines through in the financials. Look at the gross profit margin. It's around 71%.
71%. That speaks volumes about the low marginal cost of selling research, right? Write it once, sell it thousands of times.
Precisely. And the net profit margin is also very strong, 19.71% in 2024. That confirms they have serious pricing power.
But the real lifeblood, the defining financial metric for Gartner, it has to be free cash flow, or FCF. You hear again and again that Gartner is just a prodigious generator of FCF.
Yeah, and this goes right back to that upfront invoicing we talked about.
Okay. Connect the dots for us.
Because they get paid today for services they'll deliver over the next year, their cash conversion is just exceptional. Historically, their free cash flow runs at 140% to 160% of their GAAP net income.
Okay, unpack that. 140 to 160% of net income.
So, for you listening, think of it this way. A typical company makes, say, $100 in accounting profit. They might see roughly $100 in actual cash come through the door.
Right.
Gartner makes $100 in GAAP profit, but they actually collect somewhere between $140 and $160 in cold, hard cash during that same period.
Because they've already collected the money for revenue they haven't technically earned yet on the accounting books.
Exactly. It's a massive cash flow advantage. Operating cash flow hit nearly $1.5 billion in 2024. It's just a cash machine.
Okay, that is an immense structural advantage. Yet, despite that fundamental strength, the stock's massive 49% price decline has obviously crushed its valuation multiples.
Right. The trailing 12 months price-to-earnings ratio, the PTMPE, is sitting at just 15.82.
15.82. How does that stack up?
Well, it appears incredibly reasonable on the surface, maybe even inexpensive compared to some peers like FTI Consulting, which trades closer to a PE of 20.5.
So that low PE multiple is purely a function of the stock price getting hammered.
Absolutely. It's a direct result of the market pricing this company as if it's facing some kind of existential crisis, rather than just perhaps a temporary cyclical slowdown hitting its clients.
Which sets up the central investment question perfectly, doesn't it? Is the market seeing some deep hidden flaw we're missing? Or is this fundamental strength, this cash-generating power, simply being overlooked right now?
Yeah, exactly. And to answer that, we probably need to look beyond the pure financials and gauge the mood of the market itself.
Okay, Chapter 4. Market sentiment. What's the vibe out there?
Well, the vibe is profound uncertainty. That's the main takeaway. It's really signaled by the huge disparity in what Wall Street analysts think.
Okay, so what are the numbers?
The average analyst price target is currently $332.85. That suggests, maybe 29% upside from the 257 price we're using.
But
But that $332 is a sharp downward revision. The prior consensus target was way up at $476.16.
wow, that's a massive drop in analyst expectations. That signals some serious concern, maybe even panic.
It really does. And look at the range of current targets. It stretches from a low of $227.25 all the way up to a high of $546.20.
That's more than double.
Exactly. When the professionals disagree on valuation by nearly a factor of 2, it tells you the uncertainty isn't just noise, it's structural. People just don't know how to price this thing right now.
And what's driving that negative narrative?
It seems to be driven almost entirely by management's own candid comments back in Q2 2025. Now, acknowledging the declining CEO confidence, the elongated sales cycles, the market heard that and ran with a negative interpretation.
And the charts, do the technicals confirm the mood?
Oh yeah, the stock is in a confirmed long-term downtrend, trading well below its 200-day moving average. The bearish sentiment that dominated 2025 is clearly reflected in the price action. The market fear is palpable.
Okay, so if fear is driving the price, how does the ownership structure maybe amplify that? Let's look at Chapter 5, ownership structure.
Right. So Gartner has very high institutional ownership. About 91.5% of the shares are held by large funds, asset managers, pension funds, that sort of thing.
Which is pretty typical for stable, high-quality companies, isn't it? Institutions like predictable businesses.
It is typical.
Yeah.
But that concentration can also act as a volatility amplifier.
How so?
Well, think about it. When a negative narrative takes hold, like the one around slowing growth and macro headwinds,
Those big institutions might all start selling around the same time.
precisely. It might be coordinated, though usually it's just independent decisions reacting to the same news. But the effect is the same. Large blocks of shares hit the market, creating this feedback loop that pushes the price down very rapidly.
Which could explain how you get a 49% drop so quickly, even if the underlying business hasn't fundamentally broken. The selling pressure itself drives the price far below intrinsic value.
That's the theory, yes. Concentrated institutional selling can definitely exacerbate price swings.
And linking back to that management issue we discussed, what about insider ownership?
Yeah, that's another point. Insider ownership by executives and the board is relatively low, around 2.3%.
Only 2.3%? For a value investor, that low level of skin in the game, especially when you combine it with that questionable $446 buyback price.
Right. It might be seen as a minor, but still a definite red flag. It raises questions about how truly aligned management's incentives are with long-term shareholders who rely on the stock price appreciating over time, not just collecting salaries and bonuses.
Okay, so we have a fundamentally strong business, maybe questionable capital allocation timing, and a market gripped by fear amplified by ownership structure. This brings us squarely to the risks themselves. Chapter 6, risk assessment.
Let's try to connect all these pieces. The core strengths, we've covered them. The dominant brand, the massive FCF conversion, that wide competitive moat built on switching costs.
Indisputable strengths. What's the core weakness then?
The primary weakness is simply its high cyclical exposure. Gartner sells primarily into corporate IT budgets.
And those budgets get squeezed when the economy turns down.
Exactly. So the immediate threats are almost purely macroeconomic right now. They center on that sensitivity.
Like what specifically?
Well, the big one is a deep or prolonged recession, causing severe client cost cuts if companies are slashing budgets across the board.
Even essential research might start to look discretionary.
It could, especially to the budget cutters. High inflation and rising interest rates also play into this. They increase the cost of capital for Gartner's clients, making them more cautious about spending.
The source material also mentioned geopolitical factors.
Yes, it specifically detailed the indirect threat from things like the rapid escalation of U.S. tariffs of 2025.
How does that impact Gartner?
It increases global economic uncertainty. That uncertainty causes corporations to pause, to freeze spending decisions, which directly leads to those elongated sales cycles management talked about.
So the risk is that this current slowdown isn't just a blip, it's the start of a more protracted, perhaps recessionary environment where IT spending stays constrained for a while.
That's the core external threat, yes,
But looking longer term, beyond the current cycle, there are still opportunities, right?
definitely. Expansion into those new enterprise functions, HR, finance, legal, continues. And interestingly, the increasing complexity introduced by AI could actually enhance their research value proposition.
Making their actionable insight promise even more valuable in a confusing world.
Potentially, yes. Which leads us nicely to the synthesis, pulling it all together.
Sure.
Chapter 7. Conclusion. Let's try to frame the bull and bear cases one last time.
Okay, the bull case. For the long-term investor, the argument is pretty clear, isn't it?
I think so. The opportunity is essentially to buy what looks like a wonderful business. You have the wide moat, the exceptional financials, the secular tailwinds.
But you're buying it at a valuation that seems to reflect a significant overreaction to temporary cyclical pressures.
Right. You're essentially betting that the fundamental quality of the business will endure through this downturn, and the price will eventually recover.
Okay, now the bear case. What's the core argument against buying now?
The bear case warns that this cyclical downturn could actually be much deeper or perhaps more prolonged than the bulls anticipate.
Turning the stock into a potential value trap.
Exactly.
Mhm.
Especially if that revenue growth moderation we saw continues for longer than expected. If the cash generation slows significantly, the narrative could worsen.
So valuation becomes key. What did the analysis conclude on intrinsic value?
Based on a pretty standard discounted cash flow, or DCF analysis using conservative assumptions like weighted average cost of capital, WACC, between 8.5% and 9.5%, and assuming growth eventually reaccelerates from maybe 4% near term back up to 7% post-cycle.
Okay.
The estimated intrinsic value range came out between $290 and $340 per share.
Right, so comparing that to the analysis price of $257.20.
The current price stands definitively below that estimated intrinsic value range.
So the conclusion.
The conclusion is that while the risks are absolutely real, the macro headwinds are significant, and that management buyback timing raises eyebrows, the current valuation appears to offer a margin of safety.
For investors focused on what?
For investors focused on the sheer quality of the underlying business model and who have a time horizon that extends beyond the current economic cycle. The market seems to be pricing this high-quality company for a crisis scenario.
And that price dislocation, that pessimism, might be the opportunity signal for you.
It might be.
Okay, that's a comprehensive look. Now, for a final provocative thought for you to consider, we noted that the source material sees AI complexity as a tailwind, something that actually increases demand for Gartner's services.
Right. More complexity means more need for guidance.
But what happens if AI-driven analysis itself evolves into a truly disruptive technology? Could AI fundamentally diminish the value of traditional, high-cost, human-led research like Gartner's? Is Gartner perhaps vulnerable to the very complexity trend it hopes to benefit from? Something to mull over?
Definitely food for thought. Okay, folks, like and subscribe to Stock Analytics AI. For €4.99 a month, members get priority deep dives on tickers. Over the next few months, we are covering all of the S&P 500 stocks, and members get exclusive priority access to those.
And hey, if you just want a one-off deep dive on a specific company you're interested in, just drop us a super thanks on the video.
Absolutely.
And the important reminder, this analysis was generated by an AI system purely for educational purposes. It should absolutely not be considered financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.